Robert, we're live from Connect. Welcome to the show. Thrilled to have you, as always, talk about private markets. You're such a wealth of knowledge as it relates to private markets, private wealth.
Well, Michael, thank you for having me. It's good to be back.
You've been at the intersection of private markets and private wealth for years, so would love to hear how you got to where you are today at Hightower.
So, it's been a career, and really now I've arrived at Hightower. Hightower is a $300 billion wealth management firm with over 140 separate wealth management businesses that we service and support. And really we service high net worth clientele on a wide spectrum, all the way from the accredited investors who are taking their first steps into private markets, meaning private equity, private credit, private real estate, all the way up to very sophisticated families and billionaires who are require institutional caliber information and scrutiny for private market investments.
What are some of the biggest challenges with serving the different types of advisors and clients?
You have on one hand individuals who are really taking their first steps, so they need extensive amount of education, learning, education about how to invest, what the opportunities are, but most importantly, it comes back to traditional 60-40, the public market investments, 60% let's say in equity, 40% in fixed income. We now know that private markets represent a significant opportunity to complement that public portfolio, and that's true for accredited investors or people taking their first steps. It's the exact same thing for the most sophisticated billionaires who have more than 50% in some cases allocated to private markets. So what we've tried to create is, to a certain degree, a offering where we have solutions that are really geared for those early stage investors who really are learning. They have the ability to gain liquidity as needed and learn about how that could complement their public portfolio. But then we have very sophisticated solutions for the high net worth.
Where does the product innovation in the wealth space, so things like evergreen funds, come into play as you think about balancing what you just described, I think of as balancing customization with scale?
So the way we look at it is, we look at the demographics of the investor, we look at their liquidity needs, but we also look at the fact that we know that a private market allocation of 10, 20, or 30%, regardless if you're a super high net worth or simply a high net worth investor, provides you with better long-term risk-adjusted returns on a 3-year, 5-year, 10-year, and 30-year basis. So private equity, private credit, and private real estate. We have solutions for accredited investors, which are typically evergreen funds, meaning that they are open to smaller investments, where traditionally it used to be a $5 million investment, you can go as low as $1,000 or $5,000. But then we also have qualified purchaser solutions, which are for investors who have 5, 10-year time horizons, even 15-year time horizons, where they can then take advantage of those other offerings which require higher minimums.
You and your colleagues from the private markets team at Hightower, Stephanie Link and Frank Cordio, wrote a piece about the private credit market environment right now. You talked about headlines versus reality. I think it's so instructive in a time like today to hear the perspective of the wealth manager as it relates to what's going on in the market, and then what's going on with your perspective with vehicle structure.
The traditional lending mechanism that existed for 20 or 30 years has changed. And with the growth of private credit, commercial banks, community banks have been lending less, have been leaving certain areas of opportunity. And to a certain degree, what no one is talking about is one of the reasons the US economy has been flourishing and growing so quickly is because of this new mechanism, which is private credit, which is we just emerged from a pandemic. We went through rising interest rates, which none of us have experienced in our professional careers. We just went through inflation. We just went through supply chain disruption and labor shortages to a certain degree. Despite all those challenges, the US economy has been growing. And a lot of that was because of the fact that our private credit lenders, this new mechanism for lending money to companies, is much more sophisticated than traditional community banks and to a certain degree commercial banks. And they've stepped in and made available capital to private companies that to a certain degree can remain private longer because they don't need to go public as quickly. Jamie Dimon talked about 2 or 3 frauds that took place. There are tens of thousands of loans that are exchanged every year in the private credit markets. There were only 2 or 3 frauds in the last 6 months. He was referring to cockroaches, but the media picked up on that. So everyone started talking about that aspect. And what we basically saw was that generally the loans are all excellent. What we did see in the case of Blue Owl, which we also talk about in the research piece, is that Blue Owl actually were able to not only redeem on an accelerated basis 30% of their fund at par. At par, I mean, that was exceptional. They also will now simply, over the next 2 years, the remaining portfolio will be redeemed at par again. So from our perspective, this is great news, and we just felt there was a disconnect between what the media was portraying and what the reality was that we're living on a day-to-day basis.
I think that's such a great way to wrap this up. You provided such a great overview of how to think about private markets, some of the nuances of it, what's going on in the current market. So as always, Robert, pleasure to have you. Thanks
Michael,
so much.
thank you for all you do for private markets. Thank you very much.
Likewise.